You've heard the numbers. $34 trillion. 100 trillion. The numbers are so big, they sound fake, like something from a sci-fi movie. So we tune out. We hear trillion, and our brains just shut down. It doesn't feel real. So today, we're not going to talk about trillions. We're not going to talk in years, budgets, or political speeches. We're going to talk in hours. Because while you're watching this video, while you're at your job, while you're asleep tonight, the U.S. national debt is growing every single hour. And once you understand the math behind that, you'll see this isn't some abstract problem for the future. It's already affecting your money, right now. Right now, the total U.S. government debt is so large that just saying the number doesn't really help anyone understand it. So let's break it down into a unit of time we can all feel: 1 hour. The U.S. government isn't just borrowing money. It's borrowing millions of dollars every single minute. That means every hour, the debt grows by hundreds of millions of dollars. By the time a single day ends, the debt has increased by billions. And here's the part that should really get your attention. This isn't emergency spending for a war or a pandemic. This isn't some special crisis budget. This is just normal. This is the cost of just keeping the system running, day in and day out. So where does all this debt actually come from? Well, the government spends a massive amount of money on a lot of different things. We're talking about national defense, healthcare programs like Medicare and Medicaid, social programs, pensions for government workers, and of course, paying the interest on all the debt it already has. The problem is, the money coming in from taxes isn't enough to cover all of those expenses. So, the government does what anyone who's short on cash does. It borrows. How does it do that? It issues government bonds, which are basically IOUs, investors, big banks, pension funds, foreign governments, and even our own central bank, the Federal Reserve, buy these bonds. In exchange for lending the government money today, the U.S. promises to pay them back in the future with interest, and that interest is where things start to get really dangerous. Because today, the U.S. isn't just borrowing to fund new programs or build new infrastructure. It's borrowing money just to pay the interest on its old debt. Think about that. It's the financial equivalent of using one credit card to pay off the minimum payment on another credit card. Every hour, interest payments alone cost the government millions and millions of dollars. That's money that doesn't build roads, money that doesn't fund schools, money that doesn't improve healthcare for anyone. It's money that does one thing: it keeps the debt machine alive. Now here's the trap that was set over the last decade. When interest rates were near zero, this whole system seemed manageable. Borrowing money felt cheap, almost free. The debt was growing, but it didn't hurt that much. But interest rates are no longer anywhere near zero. As rates go up, the interest payments on the national debt explode. This means that even if the government froze all spending to no new programs, no new projects, nothing, the debt would still grow. Why? Because interest compounds. It grows on itself. And unlike a family or a business, governments don't really pay off their debt. They just roll it forward. When old bonds are due, they issue new bonds to pay them off. New debt replaces old debt. In theory, forever. So what does this look like in your real life? How does this abstract number in Washington actually reach your wallet? Well, it looks like the potential for higher taxes down the road. It looks like the possibility of reduced public services. And most importantly, it looks like inflation quietly eating away at your savings. Because when a government's debt gets too large, it has very few options. It can raise taxes significantly, it can cut spending dramatically, or it can create more money out of thin air. Historically, printing money is the most tempting and politically easiest option. But when a government creates more currency, it devalues every dollar already in existence. That's inflation. Prices for everything you buy go up, but your salary often stays the same. Your purchasing power, what your money can actually buy, shrinks. And while inflation doesn't show up on your tax bill, it functions exactly like a tax. It's a hidden tax that transfers wealth away from people who save money and gives it to those who owe money. And here is where this whole situation becomes deeply personal. If you're someone who earns a salary, diligently saves cash in a bank account, or lives paycheck to paycheck, inflation hurts you the most. Your money is losing value every single day. But if you own assets, things like real estate, stocks, or businesses, you're more protected. In fact, inflation often drives the price of those assets higher. This is why the wealthy often do fear government debt in the same way the middle class does. They understand something fundamental that most people don't. Government debt isn't just a number on a spreadsheet. It's a massive wealth transfer mechanism. Every hour that the U.S. debt grows, the system is quietly being tilted to favor asset owners over wage earners. This is a huge reason why housing has become so unaffordable for so many. It's why your grocery bill feels shockingly high. It's why normal life just feels so much harder and more expensive than it did a decade ago. The entire system is built on borrowing from the future. And eventually, the future always arrives. So, the big question is, can the US ever actually pay this debt off? Realistically, no. Not in the traditional sense of writing a check and being done with it. The amount is simply too large. The real strategy isn't repayment, it's management. The plan is to try and keep the economy growing faster than the debt, keep inflation running just a little bit higher than interest rates, so that over many decades, the real value of the debt slowly erodes. That's the playbook. But this plan only works if a few key things happen. The economy has to keep growing strong, and global investors have to keep their confidence in the US dollar and its ability to pay its bills. If that trust ever starts to wobble, borrowing becomes much more expensive, interest rates spike, and the debt spiral accelerates very, very quickly. This is why every hour matters. A debt crisis doesn't happen overnight like a stock market crash. It's not a sudden explosion. It's a slow, quiet hour after hour, day after day, year after year. It builds up silently in the background. And by the time most people start to panic, it's already too late. So what should you take away from all this? What's the practical lesson? First, you have to understand the rules of the game we're in. In this environment, holding large amounts of cash over long periods is a losing strategy. It loses purchasing power over time. The debt is growing faster than most people's wages. And owning productive assets is what has historically protected purchasing power. Second, stop thinking about this problem in terms of years or decades. The system is moving and changing in hours. Every hour of financial inaction costs you more than the last. And finally, don't ignore these big, scary numbers just because they feel abstract. Big numbers don't mean fake problems. They mean delayed consequences. The US national debt isn't a future issue for our grandchildren to solve. It's growing right now, every single hour. And whether you realize it or not, you're already paying for it. If you want to understand more about how people can navigate this new financial reality and protect their money in a world driven by debt, make sure you subscribe to Money Explained, because in finance, the real risk isn't knowing too little, it's knowing it too late. Thanks for watching.